Retirement is on the horizon, so it's time to downsize and move from that 4-bedroom to a 2-bedroom condo on the beach. Free up some mortgage money, right? Maybe not. In today's video, we're going to be talking about how selling your home could severely impact your Medicare Part B monthly premiums. Did you know that your Medicare premiums are actually directly tied to your income? So when you sell your home, the IRS may view the profits as capital gains, which can directly affect your MAGI, which is your modified adjusted gross income, and therefore increase those monthly premiums. This could trigger the income-related monthly adjustment amount, or IRMAA, which again could drastically increase your monthly premiums, which is certainly not something you were hoping to achieve. Now first, let's do a quick recap of Original Medicare, that is Medicare Part A and Medicare Part B. However, if you're already very familiar with Original Medicare, please make sure to check out the timestamps in the description below and feel free to jump ahead. So for Original Medicare, yes, you have to pay a monthly premium, usually just for Part B. People don't usually have to pay for Part A. But when you actually utilize your insurance, there are out-of-pocket costs as well. And that's where those Medicare supplement plans will step in to fill in those financial gaps. So as I said, usually no premium. For the Part A deductible, in 2025, that's $1,676. Now that is not applied per year, but rather per benefit period. So if you have to be hospitalized more than once in a given year, then it's entirely possible that you may have to meet that deductible more than once in a given year. So that could be a potential out-of-pocket cost. Then there's your actual coinsurance or copays when utilizing your Part A care. So if we're talking about inpatient for days 1 through 60, there's no copay or coinsurance. Days 61 through 90, it's $419 per day. Days 91 through 150, it's $838 per day. And after 150 days, you pay all costs. So again, those are some potential costs. Skilled nursing facility, days 1 through 20, that's $0. Days 21 through 100, $209.50. And past 101 days, you pay all costs. Now, 21 days, that's just 3 weeks. Think about how long it might take to recuperate from something like a hip surgery or a knee replacement. Home health care, $0 for covered home health care services, 20% of the Medicare approved amount for durable medical equipment, and hospice care, there's no charge for. Then there is Part B. Again, we already talked about that there is a monthly premium. Your deductible, unlike Part A, this is a once annual deductible, and in 2025, it's $257. So that is not necessarily as significant a cost. When we talk about the more significant costs, usually we're talking about Part A because that's your hospital care. So those charges are just going to be more significant. Now for general costs, then usually it's 20% of the Medicare approved amount. Now for something like a doctor's visit, that's probably not very expensive. But when we're talking about X-rays, MRIs, diagnostic services, etc., then 20% can be significantly more expensive. Also 20% for outpatient mental health care, just pretty much across the board. When you use Part B, it's 20% of the Medicare approved amount. As discussed, Medicare Part A is actually directly tied to your work history, and for most people, there isn't even a monthly premium. So in today's video, what we're really going to be focusing on is Medicare Part B. Medicare Part B monthly premiums are based on your income. As we've discussed, there is a base beneficiary premium, but if your income exceeds a certain threshold, then Medicare may apply IRMAA. This is why understanding how your Medicare Part B monthly premium is calculated is absolutely crucial, because selling your home can drastically affect it. So when you hear people talk about IRMAA, this is the form that they're referring to. That's Form SSA-44. And it is the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form. If you scroll down, you'll get a better idea of the tax brackets and your monthly adjustment based thereon. So basically, if you file as single, head of household, a qualifying widow or widower with dependent children, or you're married filing separately and you didn't live with your spouse in that tax year, then these are how the brackets break down for 2025. Now, if you make less than $106,001, then you do not have an adjustment. If you make between $106,001 to $133,000, then you would add that $74 to the Part B base beneficiary premium. Now, as you go up into the next tax bracket, 133 to 167, you add 185, 167 to 200, 295.90, 200 to $499.99, $406.90 per month per person. more than $499,999.99. Boy, try saying that 5 times fast. Then it would be $443.90 in addition to that base beneficiary premium per person per month. This can also affect your Part D prescription coverage, but as you can see, it's not as impactful. Now, if you're married filing jointly, then the tax brackets are slightly different. Basically, it's about 2 times the amount. But again, this is per person. So you can see here, if you were to sell your home for profit, it's very easy to make more than $499,999.99. If you've been holding on to this home for a while, but it's a vacation home or something like that, we're going to talk about that in just a minute, then this might qualify as capital gains, in which case you would have a much more expensive monthly premium. So what happens when you sell your home? Well, the IRS may view the profits as capital gains, which directly affect your MAGI, Modified Adjusted Gross Income. This is something that Medicare uses to determine your Part B monthly premiums, and it may push you into a higher tax bracket. Now, not all profits from home sales are necessarily taxed, and the IRS does offer some exclusions. The good news is you might be able to exclude a portion of your home sale profit from taxes. Here's how it works. If you're single, you can exclude up to $250,000 of profit. If you're married filing jointly, you can exclude up to $500,000 of profit. But in all honesty, these days that might still not be enough. More on that later in the video. So in order to qualify for these exclusions, you must pass 2 key tests, the ownership test and the use test. To benefit from these exclusions, you must have owned the home for at least 2 of the last 5 years, which is the ownership test, and lived in the home as your primary residence for at least 2 of the last 5 years. This is the use test. Here's an important note. Those 2 years don't have to be consecutive. So if you've lived there, moved out, and moved back in, that still may count. A brief pause here and a request. If you like what you're seeing, and we really hope that you do, please make sure to click like. It will help us to get this video out there to others looking for the same type of information. Of course, if you have questions more specific about your Medicare or health insurance in general, you can reach us in the comments below or at the number on the screen. We are licensed health insurance brokers. We're licensed nationwide, and there's absolutely no charge for our services. We can help you avoid some of these classic Medicare pitfalls. And of course, please make sure to subscribe to stay up to date. All right, let's get back to it. So why does all of this matter for Medicare? Well, let's say you're a single individual, a retiree, who has sold their home for $300,000 in profit. Well, that's still $50,000 over that $250,000 threshold, which means that $50,000 would be applied to your MAGI, and therefore you might be responsible for that IRMAA additional calculation. So we're back at this sheet again. Now let's say you, without that additional $50,000 we were just talking about, as a single individual, would make something like $75,000 per year, something like that. Well, once you add that $50,000, then that puts you into this first adjustment bracket, which means you need to pay $74 per month on top of that base beneficiary premium. Now that's only if you're eligible for those exclusions. If you are not eligible for those exclusions, you're probably looking at a much, much higher tax bracket, and that's where things become very, very tricky and very, very expensive. And the IRS and Medicare are looking at your income from 2 years prior. And that's why we say 63 is really the cutoff. So what can you do to avoid this surprise expense? Well, there are a few strategies. Time your sale wisely, ideally before 63. And if possible, spread your income over multiple years to avoid a sudden spike in MAGI. Use other tax-saving strategies, maybe tax loss harvesting, or consider charitable donations to offset gains. And consult a financial advisor. They can help you structure the sale in the most tax-efficient way possible. The IRS also offers excellent resources. If you'd like to learn more, I highly recommend checking out Publication 523. I'll put the link in the description below. That way you can learn a little bit more about capital gains from home sales and how they may affect your Medicare premiums. Selling a home is a big decision, and it's entirely possible that you have counted on the profits from the sale of your home to help you in your retirement years. So it's especially important that you don't make any of these mistakes that could end up costing you more money in the long run. Now, if you'd like to learn more about your Medicare options and other ways to save money, I highly recommend you check out this video over here. You can also learn more about Medicare with our All About Medicare playlist. If you have more specific questions, you can reach us in the comments below or at the number on the screen. We're licensed nationwide, and there's absolutely no charge for our services. And as always, please make sure to like and subscribe. We'll see you next time.